Hello, I'm Fenton Burgin, head of Deloitte UK's debt advisory team. The first quarter of 2016 has seen the first signs of a readjustment in the credit markets. European corporate bond issuance in January, normally one of the strongest months of the year, was at the lowest since 1995 at €6 billion, down 70% from last year as investors moved fundamentally to a risk-off mode, off the back of renewed concerns about the impact of China's economic slowdown on global trade, broader equity market volatility, and the accelerating deflationary effect of lower oil prices. Average US corporate yields have risen to around 3.6%, and the option-adjusted spread above treasuries rose to around 2%, compared with a long-term average of 1.3%. Interest rates and not credit are the real concern in the investment-grade market, with a potential rise in treasury yields having a bigger impact than a rise in credit spreads. But the Fed is likely to raise rates at a gradual pace off the back of increasingly cautious economic data, and many corporates that took advantage of historically low rates in 2014 and 2015 to refinance can afford to sit out a period of volatility this year. There's no great refinancing war looming in the investment grade market. In high yield, January saw credit spreads blow out to the widest since 2008. Yields on CCC or lower rated US companies hit 20% in January compared to sub 8% in the heady days when quantitative easing was roaring ahead in 2014. I think market conditions will remain very volatile in 2016, with investors having a long shopping list of concerns. Firstly, until we really see the bottom of the commodity price cycle, it'll be very difficult to see a high-yield market rebound. Secondly, 2016 will see banks and other financial institutions continuing to reduce their high-yield holdings off the back of increased regulation and their need to fully implement the new Basel III capital regime by 2019. Finally, credit fundamentals remain languid, with corporates still struggling to grow earnings. But there are a few positives. Divergence between US and European monetary policy means that we will see more international borrowers targeting the lower rates achievable in the European markets, where 10-year yields are circa 1.5% below those in the US. The yield on German 10-year government securities is sub 0.5%, and 5-year rates are negative compared to the 10-year US Treasuries at just under 2%. We're also very positive about M&A-driven financing. Right now, it's a great time to be a seller, with PE multiples in Europe close to 15-year highs. In addition, listed companies have a lot of cash to spend today. The US S&P 1200 index holds a record $3.4 trillion of cash reserves. A strengthening US dollar will also likely put US corporates in a strong position to acquire assets in Europe. And whilst recent equity market volatility may slow the pace of outbound investments, let's not forget that against the backdrop of a slowing domestic economy, Chinese companies spent $35 billion on M&A in Europe over the last year, 12 times as much as they were spending 5 years ago. In the private equity markets, 2016 will see Europe continuing to transition to a US-style funding model where insurance companies, specialist funds and private wealth funds are the primary providers of capital. We estimate that there's now in excess of €40 billion of uninvested dry powder pursuing European direct lending strategies, with a number of the larger direct lending funds having raised significantly larger second and third funds in 2015. How are mainstream LBO banks responding to these challenges? Well, this year we see increasing numbers of banks teaming up with the funds in the mid-market in deals with up to €300 million of debt to provide so-called first out and second lien structures. At the large end of the LBO market, we see funds that can move quickly and in scale, increasingly competing with traditional CLO-based capital markets solutions. So what are the key messages? In the investment grade market, we see issuers remaining cautious for the next quarter against the backdrop of continued market volatility. In the LBO arena, there's a lot of newly raised capital looking for investment opportunities, and this will likely continue to drive very favourable market conditions for borrowers. Finally, against the backdrop of slow organic earnings growth and companies sitting on record cash balances, we remain really positive on the potential for a pickup in European M&A activity over the next 6 months.